With markets constantly evolving, the debate between growth stocks versus value stocks is heating up again. Over the past decade, growth stocks have dominated, led by tech giants and innovation-driven companies. But as we move into 2025, many investors are asking, is this the year value stocks make a comeback? Let's break it down using key market indicators and historical data. Let's start with a quick look at historical performance. If we compare the MSCI USA Growth Index to MSCI USA Value Index, it's clear that growth stocks have greatly outperformed value stocks over the past 15 years. This trend has intensified post-2020, with the tech boom and AI-driven market rally increasing the gap. The ratio between growth and value stocks has reached new record highs, confirming that growth stocks remain in the lead. Despite concerns over rising interest rates in 2022 and 2023, growth stocks continued their strong performance. Also, after the first Federal Reserve rate cuts in September 2024 and the subsequent reductions in the following months, growth stocks have maintained their outperformance, defying expectations that high interest rates would favor value stocks. So instead of focusing on the correlation with interest rates, let's examine industry-specific growth rates to compare traditional growth stock industries against value stock industries. Growth stocks are largely driven by sectors like technology, consumer discretionary, and communication services. These industries have consistently led the market due to innovation, high revenue expansion, and increasing market demand. For example, companies in AI, cloud computing, and e-commerce have seen double-digit earnings growth, pushing their stocks higher. On the other hand, value stocks are typically concentrated in industries such as financials, energy, industrials, real estate, and healthcare. While these sectors offer stability, their earnings growth has been more moderate. Industries like banking and energy depend heavily on macroeconomic factors such as interest rates and commodity prices, because their revenue and profitability are directly tied to these external conditions. For example, banks generate significant earnings from interest income, which fluctuates with rates changes, while energy companies rely on stable commodity prices to maintain profit margins, which can therefore limit their growth potential compared to the high growth sectors of the market. By analyzing these industry trends, we can better understand which sectors are positioned for strength in 2025. While growth stocks have remained dominant, investors should pay close attention to potential shifts in economic conditions, policy changes, and sector-specific catalysts that could influence the balance between growth and value investing. Now let's compare the PE ratios of individual growth and value stocks to see how they stack up in terms of valuation. Growth stocks, known for their high price-to-earnings multiples, tend to trade at a premium due to strong future earnings expectations. Let's take a look at these example stocks: Nvidia, Tesla, Amazon, Microsoft, and Apple. On the other hand, value stocks generally trade at lower PE ratios, offering stability and strong dividends. Here's how they compare: Berkshire Hathaway, JP Morgan, ExxonMobil, Johnson & Johnson, and Coca-Cola. Looking at this comparison, it's clear that in general growth stocks continue to trade at higher valuations, reflecting investors' confidence in their future potential. However, value stocks remain more affordable and could be attracting to long-term investors seeking stability in an uncertain economic environment. As concerned growth about a potential market downturn in 2025, investors, both institutional and retails, are adjusting their portfolios to mitigate risk while seeking opportunities in uncertain conditions. One of the biggest shifts has been the increase in volatility hedging. More investors are moving capital into defensive assets such as gold, US treasuries, and low volatility ETFs. The demand for safe haven assets has surged as uncertainty around interest rates, inflation, and geopolitical risk has surged. At the same time, many investors are adopting diversification strategies that blend high-growth stocks with stable dividend-paying value stocks. This approach helps balance potential upsides while providing a cushion against sharp market declines. Additionally, hedge funds and institutional players have been raising cash positions, signaling a cautious stance. The increase in cash position suggests that investors are waiting for better entry points rather than taking aggressive points in equities. So what will I do now, and also do recommend, but please keep in mind this is just my personal opinion and no financial advice. So given the market landscape in 2025, retail investors should consider strategies that balance risk and reward while taking advantage of prevailing trends. So first of all, diversification is key. Avoid over-concentration in either the growth or value stocks. A well-balanced portfolio that includes high-growth technology stocks along with defensive dividend-paying stocks can help in uncertain markets. Second, be tactical with cash and defensive assets. With market volatility expected, holding a portion of assets in cash or short-term bonds can provide liquidity for buying opportunities. Defensive assets like gold or treasuries can help cushion against potential downturns. Third, follow smart money but stay flexible. Keeping track of where major funds and hedge funds are allocating capital can offer insights, but retail investors should remain adaptable. Instead of blindly following the institutional moves, look for undervalued stocks with strong fundamentals and sectors that may gain traction as economic conditions shift. So with that being said, what is your opinion? Will growth stocks continue their streak, or will 2025 finally be the year of value stocks with an upcoming downturn in 2025? Let me know in the comments. Thanks for watching.